Good afternoon, everybody. This is Dennis Wilburn with the How to Make Money Trading Stocks webinar. Joining us today from Switzerland is Michael Bishop. Michael, how are you today?
I'm fine, thank you.
Okay. And
we have a really nice spring day.
Wow, cool. And so it's actually a beautiful day over here also. We've been raining for about the last 2 weeks, and now we actually see some sunshine today, which is nice. Mike Traeger is somewhere in Dallas. If you see Mike, just make sure that you tell him that he needs to be on the call right now. But anyway, I want to welcome everybody. Hey, David, how are you? I always love your enthusiasm, David. It's awesome, absolutely awesome. Let's get going. We got a lot of stuff to cover. I'm glad Michael joined us today. I want to talk a little bit about the current pullback that's underway. You know, what's the essence of that, and how that's being viewed from a European standpoint. And so I want to remind everybody that all the materials that we present are for training purposes only. Traders should always paper trade any new methods prior to the risk of their own personal capital. Hey, do me a favor in between now and next week. If you enjoyed this, this specific, free webinar that talks about the market, what we see doing it, and gives a global kind of perspective by having people plug in from all over the world, please share it with a friend. I mean, we would love to have more people online, and share, and we'll get some more guys online, and we can chat about it. Hey, Dan, how are you doing? Happy birthday. And here is Michael's disclaimer, and there's Michael's email address if you want to chat with him. Michael brings a lot of good experience and perspectives to what's going on in the markets. And well, you trade with a U.S. broker and a Swiss broker, right?
I almost only use the U.S. broker.
Okay.
I mean, it's just commissions are so much better.
Okay. So, well, do you trade the European stocks with a U.S. broker, or do you primarily focus just on U.S. stocks and ETFs?
I focus, but not primarily.
Okay. Okay. I know that when
so basically 90% is U.S., even more, 95 I would say is U.S.
Well, I know when I visited, my wife and I visited Germany a few years ago, and I can't remember the exact time frame, but I think the U.S. stock market opened at like, oh gosh, 1 or 2, 3 o'clock in the afternoon.
It's 3:30.
Okay, and then closed by about 9 o'clock in the evening. Is that about right?
10.
10 o'clock. Okay.
It's 10 p.m.
Okay, but it was a lot of fun because it gave us the opportunity to both get out and do some sightseeing and enjoy being there, in Germany.
Yeah, it's perfect. It's perfect.
And then come in, and right before taking an afternoon nap, check what was going on in the market, and then place the orders, and it was really awesome. And with the with the mobile hotspots that are out there, and also the connectivity that was available was really awesome. The other place that I liked trading was when we visited South Korea, because South Korea is really interesting because in South Korea the U.S. market opens up, I want to say, at about 9:30 or 10 o'clock at night in South Korea. And so basically it's one of those things where you do your stuff right before going to bed there. By the time you get up in the next morning, the market's already closed. But basically, you know how things went. It really teaches a person to learn how to use conditional orders, which is an important aspect for all traders, at least I believe. And so, okay, let's get into getting going. Here's a little bit about my background. That's been up there long enough for you to take a look at. I started trading for a living back in 2006, and I've done all kinds of training, a retired Navy guy, civil engineer. I actually taught in an MBA program at Chaminade University here in Hawaii, and but I don't do that anymore. I just basically coach, teach, and trade. So speaking of which, active trend traders put a very high premium on our coaching and teaching, and our main sessions are on Wednesday evening. We spend an hour going through what the market's doing, but also then getting into some really in-depth trading. Got some excellent email back from this last Wednesday night where we talked about the nuts and bolts of strategy 3 and how to utilize that and how to better time your trades coming in and that type of stuff. This week is going to be it's going to be a really special training session because I'm going to go over 2 simple go, no-go indicators that if you trade the Thinkorswim platform, these 2 indicators will basically help you answer the question visually, is it time to get in and or get out, or is it too late? Am I too early? So it's really driven towards providing people an additional level of confirmation, and also provide people with the ability to work on that old patience gene, because we as human beings, we occasionally tend not to be too patient. And so, Michael, this is going to be a good presentation.
Okay, looking forward.
Okay. And so, anyway, we're talking about the craziness in the market. I mean, absolutely insane. It's been going up. But this week, we're getting a brief, what appears to be, we've had about 2.5, nice pullbacks since we started the rally back in early November. Now there is a tendency, as the further you get into a rally, that the pullbacks that have the later stage pullbacks, if you will, tend to be not as, you don't carry as much momentum into the thrust upward after the pullbacks, and so that's what we may be seeing in the market right now. So brief pullback, or is there going to be more? More of a pullback, more of a sustain. I won't say a correction, but maybe a healthier pullback that would pull us back somewhere between 2 to 5%. We'll see. Pullbacks in the S&P. Do we buy this bounce, or do we be careful with this bounce? Some folks, have the belief that when you get a bounce and you have been in a long-term uptrend, to go ahead and buy all the bounces until the bounces stop working. But this morning, the bounce was just a little bit. We had divergence between the longer-term weekly charts and the daily charts, and so it makes this particular bounce a little bit more suspect in both the S&P, the NASDAQ. S&P, appearing to be bouncing off support, but then what? What's coming up that's going to influence the market? Well, next week, well, as you all know, the jobs report came out today. The economy created almost 300,000 jobs in the month of February, which is, significantly higher than the average from, the past 8 years, which is very interesting. And Michael, when we start getting up in the 250,000 jobs to 300,000 jobs, those are the numbers that used to drive some of the big, huge economic recoveries in the U.S. at least several years ago. And so, I don't know, in Europe, do you guys pay that much attention to our jobs report?
I would say professionals, yes. In the media, a little bit.
Okay, okay, well, that's fair. Um, and
And I mean, I mean, of course, more in focus are the local
okay,
reports, and there, as you know, we have huge differences in Europe. I mean, Germany has now almost so same situation as in the US, Switzerland the same,
okay.
but Southern Europe is still a mess.
That almost seems like that's a historical thing that continues going on forever. Southern Europe is a mess. And
Yeah, I mean,
go ahead.
I'd say it's a different style of living, and yeah, it's all
Yeah, in what I
in a
mean,
way it will always be
like
that
less
way.
productive, or a little bit more laid back, or
Yeah, enjoy life.
okay.
And if you don't, so if you have no income or a very modest income, maybe your sister helps out, maybe uh, somebody else in the family has a house and let it, and you don't have to pay for the rent, or you make some maybe side jobs, second jobs
Oh,
that are
okay.
not officially registered, and so on. I mean, at the end, people survive, and I think maybe they have more fun than kind of the
And the more
northern countries.
productive people. I don't know. I think there's been psychological studies that show that um, people who actually have, that have jobs and all this kind of stuff and that are producing things are actually much happier than those who don't. But that's, we'll save that for another day. Um, I've been, looking at, weird news this morning as the market was kind of like, just kind of flopping around a little bit. And I came across a really weird news story that may, and whether or not it ties into the market, I don't know. But did you hear about the veterinarian in Contra Costa, California?
No.
Well, this veterinarian in Contra Costa, California is doing sex change operations on dogs and cats.
Okay.
Because now, how in the world, the pet owner knows that they have a transgender kind of animal? I haven't got a clue. But but literally, I mean, seriously, and this guy, and I'm sitting there going, that's insane. That's close to, in my perspective, close to, animal cruelty. But one of the people interviewed said that well, his dog um, wanted to be a female dog, but in reality wanted to be a female cat. But they weren't able to do a trans species type of correction. But this vet, has a 6-month waiting list for people who want to have the sex of their animal changed. So they, I'm sure that's not, cheap to do, but that's insane. It's absolutely insane. Kind of like, and I think it's just kind of reflective right now. Now, what that has to do with the market, I don't know. But if you haven't seen that, you heard it here first. Let's get on to get back to the market. So here's the percentage of stocks above the 20-day moving average that Mike Traeger and I follow with the early warning alert system. As you see earlier this week, yesterday in fact, it pops down, touches off the 30. This is not a buy signal. This is just basically, we are looking for this to get down into the lower level below 30, and then we're waiting for the trigger signal to come off of that for the early warning alerts. However, the thing that is interesting at least I think, Michael, in this, is that you still have the S&P holding up fairly well when clearly, and we'll take a look at this when we look at the charts of the indexes. The NYC has only less than 35% of its stocks are above the 20, which means, yes, David, that is absolutely true. And so anyway, basically our non-weighted indexes are taking a larger hit. I was reading an article just yesterday and last night that talks specifically about how the Russell, which has a lot of small oil companies in it, well, when oil took its big dive on Thursday or Wednesday, we had gotten in thinking we were going to bounce off support on the UCO, and instead the oil report come, how much is in surplus, not surplus, but storage oil, it came out, basically said there's a glut of oil that's out there, and it was hammered. Well, a lot of these small oil stocks, these small cap oil stocks, also got hammered. Now, and what are some of the other things that could play into that? Well, apparently somebody mentioned earlier that Eric talked about we've had some really excellent weather on the mainland, in the mainland U.S. That has helped with job creation, getting people out there working and that kind of stuff. Well, it's also probably helped in that fuel oil and that kind of stuff has not been sold as much. Therefore, there's a surplus of oil right now. So, but we'll take a look when we get back over. Again, we're waiting for moves down into here. We'll see if we get them, or if we're going to get a bounce from this point here to drive its way back up. And let's get over here to the charts. Okay, here's where we're sitting. The Russell, in fact, is down from last year's high, while the other indexes are still maintaining their above last year's high and also driving up, with the NASDAQ being up almost 11% as of when we put this out earlier today. So let's take a look at the S&P. Okay, the S&P, and I want to highlight, the first thing I want to highlight is two different things. Is one, on a daily chart, it appears as the S&P, the TSI, and the momentum is bouncing off of the support of the zero line approximately. However, we see here on the weekly chart, and this is where we have some divergence, weekly momentum is kind of flatline. The TSI is in fact turning over. Now, typically when that turns over like that, we get a little bit of a pullback, as we've seen, see on a weekly chart. Every time we had that last year, you get a slight pullback. You had put in a high, and so that started to roll over last week. It has not, the short term has not broken below the long term, but as you can see, on a daily basis, it looks like it might want to turn up. We'd prefer to see it closer to the zero line. But yesterday, we came down and we bounced off of the past breakout area, about the 2353 area. Also turned out to be the 20-day moving average. This morning, we get a gap up. And this is one of the things I was looking for, Michael, is what will be the quality of the move off of support. And initially this basically gapped up, fell back down into the below the 8-day moving average, and so I'm watching the S&P. If we close back below the 8-day moving average, this may just be a weak little reaction, and we're going to have some more downside. Primarily highlighted off of the longer term weekly TSI rolling over. But we've got a good level of support, the 2353 level, 2354, and we know we have 2400 as a level of resistance. And so that's what I'm seeing going on there. The price action on the weekly is still extended, above and significantly above the 8-week, 20-week, 40-week. And so a healthy pullback would not be a surprise at this time, but at the same time, we're going to have to push back up above the 2377 level, and we'll see how it, if this is a rebound, how is it going to retest in there? It may pull back down here, or it may also just do one of these numbers where it basically sticks its head up, and the question is, will it get back to the 2400? If it does not get back to the 2400 and rolls over, that's a good indication that was just a weak rebound, and then there's more downside to come. The Deeper asked the question, how come only 30% of the stocks are above their 20-day moving average, but the S&P is at and or as near the high? The main reason for that, Deepa, is because the S&P is a weighted index, and so the larger cap stocks on the S&P, they have been outperforming. They're stocks like the FANGs and Apple and that kind of stuff, and so one could say artificially hold up the indexes like the S&P and the NASDAQ, while the NYSE, that's the chart that showed percentage of stocks above the 20-day moving average. The NYSE is a non-weighted index, and so each one of the stocks in that is equally weighted, and so that can be what's drawing it down. So, Michael, do you have anything here on the S&P that strikes you?
I really liked your analysis. So
okay,
that's perfect. Yeah, I couldn't say it better.
Okay, let's take a real quick look at and well,
just a little comment. If I just look at the current 15-minute slide,
yeah,
or chart. I mean, the bulls are not dead. It's kind of unbelievable. Yesterday we had this V pattern, and it seems they're coming back today.
Yeah, and we'll see how much vigor the bulls come back with. The buyers come back in with, and right now we don't know what that's going to be. But NASDAQ, again, a weighted index, as you can see, holding up very well, back up close to the past level of resistance, up here just shy of 5,400. And what's it going to do from here? It also has the TSI not attempting to roll over right now, but it's up above the positive 50 level, which tends to be an area where it starts to soften. Can prices push up from there? Sure they can. But we'll have to see how much further they can move up. One of the things that's interesting to watch is, let's see what happens if, let's say the index, the NASDAQ, does break out and start to move up. Well, we would anticipate the TSI to also start to move up, and also momentum to continue moving up. But as this pushes, and if we break out above the 5,400 level and onto new highs, the question we have to ask ourselves, are the momentum indicators pushing to new highs? And if they stay down, at the 50 level or between the 50 and the, say, 80 level, then what we'll have is we'll have a negative divergence going on. That can be a clue to us that, okay, yes, the index is pushing higher, but it's pushing higher with less momentum, which is oftentimes a clue that when it rolls over the next time, it will roll over with more vigor. So let's take a look, Michael, at the Russell. Now the Russell is not a weighted index, but it does look like it is finding support right at that 1360 down to about 1340 level. But it has not reversed yet. If we finish where it's at right now for the day, we will have a bullish harami. However, we have had a bearish cross on the 8 crossing below the 20, and we are operating below the 50-day moving average. It too, as you can see over on a weekly chart, is showing that the TSI is pointed down and has crossed. Momentum is approaching the zero line. If it breaks below the zero line, that typically means that that entity is either in or will quickly move into a downtrend, unless price action reverses. So we've got a really interesting pattern going here with the Russell on a weekly basis. Is 3 weeks ago we get kind of a bearish, not quite a bearish harami, followed by a shooting star, and we're getting a resolution to the downside. And again, this is a non-weighted index, and you can see it is a lot more to the downside than the S&P and or the Russell. Take a look at the other non-weighted one that we look at, which is the NYSE. Now the NYSE had a really healthy pullback below the 20, came back up and has bumped its head against the 8, and will it close back down below the 20? At this time we don't know, but it is a level here. If it closes below the 20, that increases the probability that, hey, that would be 1, 2, 3 closes below the 20, increase the probability that we may be going down to test at around the 50, and the 50 is just below this past level of support that's identified by that swing eye, which is at about the 340 level, and so that would put it back down into about that area right there on the weekly chart. Again, it too has, as you can see, we had negative divergence, and the TSI has turned over on the true strength index. So any question on the indexes? Michael, any comment on the indexes?
No, not so far.
Okay. So
what I saw, and I think I mentioned it last time, that we have the first major ETFs that break in, or that have fallen, like the energy ETF, the minus ETFs,
XLE.
That's XLE and XME.
Okay.
And the other is XOP.
Oh, that's gas exploration. Okay. Yeah. Now, something interesting that came up that I was reading a little bit about is that there currently is a little bit of a conflict between OPEC and the shale oil, the Shell, the SHALE oil producers here in North America, that there's the conflict being OPEC wants to come out and set a price, or they want to regulate output, but the shale producers are going going great guns and saying, okay, you cut your production, we'll take up the slack, even if the price of oil is going down. Have you seen anything about that?
Yeah, I follow a blog of a guy who watches this closely. I mean, basically you could say the whole price agreement of these associations doesn't work anymore.
Oh, okay.
And whatever OPEC says, after a couple of weeks, the outcome is different because one country does not follow the rules or uses another excuse not to follow.
So do you think,
And so what the guys I follow, and it's really not a special field of mine, is that the oil price is there is a lot of downwards potential.
oh, okay. Well, Charlie just mentioned here that some shale producers now can produce a barrel of oil at $30 a barrel.
Yeah.
And so that's, because wasn't the production price used to be up in the, 45 to almost $50 a barrel, Charlie? I think it was. That's why initially shale wasn't very attractive. It was attractive, but it had to be over a certain price. That's interesting. Oh, much higher for the production standpoint, and that's an important thing to consider. So anyway, and let's see, Michael, you mentioned, and if you take a look at those, like here's XOP. XOP is the S&P, the Spider Oil and Gas Exploration. It does about about 12 million shares per day, and so it's something that you might keep your eye on. But you can see, rolled over, dropped like a rock, and then of course we follow. We'll give you, this is a kind of a free. We follow USO, and look at it, a very similar. This is U.S. oil, and liquid propane, and as you can see, when they came out on Wednesday that they had a glut, because we had a nice gap down into support, and then it cut through support like a knife going through butter, and is now been whacked 2 days in a row. Had what looked to be it was a very nice hammer after a downtrend yesterday, but then that reversal signal, as soon as we cut below that, the low of yesterday, is now voided. And so now what I would be anticipating and waiting, and this may be answering a question that you have, Eric, is I would be waiting for my TSI to give me a reversal signal also, along with a reversal signal in oil itself. Now you have to recognize USO, or if you go over here to UCO, get that reversal, because right now you've got both the true strength index on the daily basis, on a weekly basis, running hard towards negative 50. You've got the momentum pointed down, and that is a significant sell-off back into a level of support. One of the things that Mike Trigger was also talking about, let me get the futures up on this, and let's take a look at crude oil, the futures of crude oil. You can see they've sold off also, and look what's happening today. It's appearing, it bounced yesterday off the 200-day moving average. However, now it's in the process of potentially closing below the 200-day average, which could mean that oil's got some more downside to go. And who said $40 did anybody say $40 a barrel? That may come to pass. And so would that be good for, is cheap oil good for economic expansion, Michael?
Well, I mean, there is a positive correlation between oil and the big indices.
Yeah.
but it's not extremely strong, and it also hasn't been that reliable. So I think it lost in terms of reliability year after year, the
Okay.
last couple of years.
And so if you are interested in trading either USC, USO, um, XOP, keep an eye on crude and what its futures are doing. And I just drew this little trend line in here that approximately connected these three lows, past lows, and that may give us an indication of where we could anticipate, a potential stop, or potential support level. Let's throw on really quick in addition to that, a little fib. And as you can see, a 60% retracement, 618 retracement would coincide, intersect at $47.19. So worth keeping an eye on, and that also may provide us where we could anticipate some kind of bounce. But as I said earlier, and this is for Eric, I would be waiting for us to get a positive uptick on our TSI, just the way we wait on, a lot of our other charts. Wait for a positive uptick, and if that matches up with a reversal candle, awesome. Then that's going to be our kind of our initial, a combination of clues to say, yeah, oil may be coming back into a buy position. So just kind of keep that in mind. Because Eric has sent me an email a little bit earlier about what I thought about oil, and so that's what I'm thinking, and especially since this past support didn't hold, and since that past support didn't, let's take a real quick look at it. That past
Maybe you
result.
can show it that, and the next time I send you this one. It's a nice table about life expectancy for oil reserves,
Okay.
and it's growing and growing kind of every year. So now Libya, for instance, is supposed to have oil for the next 300 years.
Oh, yeah. Everybody talks about that concept of peak oil, and it's kind of interesting that oil seems to be a commodity that continues to be discovered, if you will, in various ways. If we take from the high to the low and then extend it down, that provides basically a downside target after breaking out of that range down here at about 46.24. So somewhere, and so that our other target was about 47. And so that appears to be a potential support zone where oil may, in fact, try to bounce. But it has to bounce before we can say, yep, that's where it's bouncing. But that's where I would project it down to. That's on oil. And now you can just take that same information, run over here to either USO or to, I would go to USO rather than UCO, because go to the non-leveraged and track against that. It doesn't look exactly the same, but you can still get a pretty good indication. Oops. I know we're not actually getting off course. We're actually providing a really good lesson here about, and there's the same trend line that I connected on the other ones, approximately. So that gives us, that puts us down in the $10 range, right, down in this area. And the other one, based on that same information, would put us down lower than that. But who knows? USO may test all the way back down on the $8 level, and its seasonality is shot out the door. I know, Bob, I saw that. Bob just mentioned that a new field was discovered on the North Slope in Alaska, not in the ocean part, but 1.3 billion barrels. I think that'll last my lifetime. So, okay, let's get back to what we got. Okay, and we'll get wrapped up. I hope you like that little that little detour went on really quickly. Anyway, okay. Seasonality on, and I've talked about everybody about seasonality. We're going to see what transpires. February was not a weak month. This either a regular, for the regular years, or the seasonality of the regular year, or certainly the seasonality on the post-election market. And then Michael sent me this chart last week. We provided that in our discussion last week. Michael, this is the chart you sent me last week. What struck you about this particular chart that showed when both January and February are up?
It's a week ago, so I have to rethink it. Yeah, basically it says if January and February are both higher, which does not happen that often, then we can expect a good year. And that was kind of the one side of the medal. And then I really took a look into the Avril charts, and then I seen that really most of these years have been quite choppy markets.
Okay.
And what was even more interesting is that I think with the exception of 2011, there was no year where you could say if you missed the train in January and February, you never had an opportunity to buy in for the same or even a cheaper price.
So let me make sure I understand that correctly. That if you missed the initial move in January and February, that later in the year, because of the volatility that was present in the market, you would get a secondary potential entry entry point that would have matched what you could have gotten in January. Is that what you're saying?
Yeah, exactly. So basically, you always got a second chance.
Okay. Okay.
So,
awesome.
or in other words, it was never a good strategy to jump after a missed January-February rally.
Okay, so in other words, don't buy the highs, wait for the pullbacks.
Yeah.
Awesome. And so 1987, which was a very good year, in 2011 were the 2 years out of these 26 years where the actual index finished down for the year. But in all the other, and this is rest of the year returns. So that means from February, this is what the return was through the rest of the year. And as you can see, they're pretty healthy. I mean, all the way from 18, a couple of 20s in there. And so, but it's really great to know that there will be secondary opportunities to get into the indexes, and of course we'll be looking at the leveraged index ETFs throughout the year. And so that's what we're counting on, and that's what we'll be waiting for.
And 1987 was a crazy year. I think you made almost 40% in October, and then you lost 40%.
Oh, jeez.
Or you made 30% and then you lost 40%.
Yeah.
Like that.
There was another year like that, and I want to say it was like, and it doesn't show up here, but it was in like 2007, 2008. Market was down significantly in 2008, but if one waited for the October rally, the indexes, almost every one of them moved up 20%. So, which tells me on seasonality is look for the, and Mike Traeger and I had a really long talk about this, is while the concept of seasonality is very strong, it's a great thing to be aware of. Waiting for a positive turn with a TSI tick up either on a daily or weekly chart is improves your probability of the trade being successful. And so we'll move from there. But Michael, I really like this chart. I'm glad you sent it to me, and it went well. So as of right now, okay, Michael, it's time to vote. Which way, where's your path of least resistance?
So I would be very surprised if March again there is no downturn.
Okay, so March
So,
you would be here?
yeah,
Okay. Now, with a big downturn or just a pullback?
a pullback.
Okay. And so, yeah, I would.
And maybe we then really need another crazy up move before kind of everything collapses.
Yeah, I could see weakness or a pullback, if you will, in from March into first part of April.
Yeah.
And then April, of course, usually get a nice little move up.
Yeah.
As people with their 401 are trying to beat the tax man and getting in their 401ks early, so a lot of cash comes rolling into the marketplace again. So that's what I would be looking at. And then potentially I think a big unknown is one, future interest rates, and how successful is the Trump administration going to be in getting lower taxes, that's LT, and they already done a pretty good job of getting a reduction in the regulations that impede business growth. But the one thing about it is if we get, one of the things I was thinking about, this is kind of funny, is about midway through the Obama administration, they modified how they measured the employment rate or the unemployment rate, and they basically adjusted it so that the long time, the underemployment rate didn't have as big of an impact. In fact, they took it totally out of the equation, and so it made it unreported, but it immediately made the employment rate, which was at the time about 11%, 10-11%, made it look much better. It dropped it, and it dropped to about 7, and it dropped to 6, 5, 4, 3, but it's based on a different measurement. And so I was just sitting there going, it's really interesting, is and it's purely kind of just a head fake speculation. If they don't somehow readjust that, could there be a potential for the U.S. employment rate to actually drop to about 1 or 2? Because they had dropped 3 or 4% off of that previously. Anyway, just a off the cuff comment. And then the Fed would totally be freaking out because their Fed has the mandate that that unemployment should stay, above, what is it, 2.5% to 3%, or is that inflation? One of the two. Anyway, so excuse me for
it's inflation.
Huh? Yeah, it's inflation. But yeah, I find it kind of interesting. So yeah, I can agree with that. Short term, nice little pullback into a rebound. But then the other unknown is if what they're working on to get the economy really firing on all cylinders, if that is delayed any whatsoever, I think that could be a catalyst to suck the oxygen out of the market. But we'll see. Okay, here's what we're sitting at. Wagner is this negative 451 that is getting hit on the UCO trade earlier this week, and but everything else is clicking along. And again, as long as we, by the end of March, that's why I don't necessarily like to post these mid-month, but in all, to be totally, transparent, I want to show, okay, here's where we're going at this week. But it also gives you a flavor for, in the world of trading, it is like a commission job. Some weeks they're amazing, other weeks they're less than amazing, and so it zigzags a lot. So here we go, and this is the closed trades. Now I haven't updated it for March yet, but strategy 1's down a little bit, strategy 2's up a little bit, strategy 3, and so cumulative we're sitting about 4% for the year so far. And so anyway, for future presentations and events, for the Bay Area Moneymakers, we will be doing 2 webinar training sessions in the month of April. Wednesday night with the active trend trader, we'll be going the go, no-go indicators. Again, I think you're going to really very much enjoy this. I may do just a brief intro video over this weekend to talk about one of the indicators, but I won't give everything away. You have to tune in on Wednesday evening to get the rest of that. And so appreciate everybody who does tune in to the live Facebook market updates as those go out. And as you do watch the videos, hey, please, if you like what you're seeing, please give us a thumbs up. And and if you have any questions about trading, about technical analysis, about anything, please send me an email regarding those questions, and we'll do a bonus training video for a question per week. I want to remind you that the active trend trading system is based on the 5 pillars of active trend trading. We identify what to trade, and we focus on top quality IBD growth stocks and top-notch ETFs. When to enter, when to exit, what strategy we're going to use, and what to expect. So, but it all boils down, Michael, in reality, all of trading boils down to these 3 entities. 1, know the trend, define the area of interest where you're going to take action, and define your triggers, strategy, and targets. And that's targets for both stop losses and targets for profits. We only control, we are only in control when we enter the trade and when we exit a trade. At all other times, the market is going to go where the market wants to go. So Michael, how long have you been trading?
So I came from investing and trading around 3 years now.
Okay. And you like trading better than just doing the investing?
Absolutely.
Okay.
Absolutely.
Excellent.
I mean, there's much more know-how involved and not that much luck.
Okay. And so, anyway, I have got to get closed down here. We're going to move on to the next session. Remember, this weekend, to spring forward, I believe it is this Sunday or Saturday night, you set your clocks forward because daylight saving time starts on the U.S. mainland. And so, do they have daylight savings time in Europe?
Yes, but it's a shame that it's not possible to synchronize this. I mean, it's really ridiculous.
And so, well,
I think the difference is just 1 or 2 weeks, so there can't be any big concern behind it. But they just don't talk to each other. I don't know the reason why.
Well,
because it's really, I mean, also for trading, you really have to write it down twice because it's a nonsense.
Well, tell me about it. When daylight savings time starts on the mainland, in Hawaii, you have no daylight savings time, and so the market opens at 3:30 in the morning here, And so that means I have to be, if I'm going to get up an hour before the market opens, I got to be up at 2:30 in the morning.
Yeah. I remember it's quite a long time. I was once in Page, I think that's a city in a border city between Arizona and Utah, I guess.
Okay, yeah.
And Arizona does not have daylight saving time, and Utah does have. And
Yes.
and to make it even more complicated, I think there's also a line between, you know, Pacific time and the other time.
Yeah, mountain time.
So basically in this little city you have 3 time zones.
Jeez. Well, with that, guys, we're going to call it a day. I've got to get on to the final hour. And so if you're tuning into that, I'll be there shortly. Michael, thank you so much for your input today.
Thank you for having me. Have a nice weekend.
Okay, excellent, everybody. God bless everybody. Have a wonderful weekend. And the video will be out a little bit later today. Thanks a lot. Bye.